Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. We are doing, Rob and I of the Mindfull Investor are doing another podcast for you guys. Today, the topic is options. So, stock options, and we're going to try to give you a little bit of a background, and then each of us has a different way of how we work with options and how we make money off of options. So we're going to go through that and introduce everybody. So here's Rob.
Yep. Hi, Alesh. Thanks for having me again.
Now I did a spreadsheet, which being an IT guy. So, uh, okay, so with the spreadsheet, what I've done is so the date is when I sold it. Was it a put or a call? And about 80% of them are puts. What the symbol is, what the strike price is, when the expiry date is, the number of contracts. So this is what you were talking about, Rob, is that we're dealing in contracts. Um, this is what the price was per share. This is the exposure. So I'm multiplying the the strike price times 100 times the number of contracts. This is the premium that I got, and then I have annualized the return, where you have, this is what my premium was divided by the exposure. So when I say the exposure, it's either the amount of stock that I'm going to have to buy in dollars if I'm selling puts, or if it's calls, the amount of stock that I'm going to lose if the price goes high enough. In this column, we're sort of looking for green, where expired worthless is EW, and then of course A is where I was assigned, meaning I got the stock or I lost the stock. So so for example, here we have Afria. It's a cannabis stock. 6,000 was my exposure, 6,000 was my purchase. Now, at the time that I got it, it was worth $59.90, and I got it for $60. So I actually turned out really lucky in that it just went just slightly below. But here's the fee. I ended up paying a $70 fee to my brokerage. I did end up coming out in the positive, but that doesn't always happen. The worst one was where I sold a call on Afria. So I got Afria at $6. I sold a call at $8, and it went to like 14 or something like that. So I lost out on about $7,800. Yeah, I missed out on $7,800 by virtue of having sold that call. So from that perspective, I was down 5,500, but in actual cash flow, I was up. I was up because I bought it for 6 and I sold it for 8. So in some cases, I turned around and I sold the stock immediately. So with some of the calls up front, I was able to sell the stock. But yeah, really, the red in these columns is the only time that I lost money. So I have kind of a handy summary over here. So I collected 16,000 in premium. I had 14,000 in cash flow. The reason why my total profit is 6,000 is because of this negative 5,500. That was the huge missed out on loss. It wasn't actual loss, but to be fair. And then I always have a little thing for myself just through Excel formulas. Next options expiry date is actually tomorrow. And so I'm on the hook for $7,200. So this is just for me to have the cash ready if it was puts that I sold. Yeah, I sold 78% were puts, 22% were calls, and 82% expired worthless. So it is sort of what you're hoping for, but then if you wanted the stock, you missed out on getting it. So I think about 75% of options expire worthless. That seems to be the kind of the going statistic that I've heard. Rob, does that sound pretty close?
Yeah, I think it would be higher actually. Yeah, like
Yeah.
maybe
Okay.
85%. So I think
Really?
selling options is like better for beginners because you have a winning odds on your side. Like
Hmm.
like that's the odds. Like you have 80% of a chance of winning. So
And especially
yeah.
with puts, if you're selling puts and you're assuming an upward trending market, then selling puts would be kind of just, even if you're doing it blindfolded, that gives you the best chance of coming out ahead. Um,
Yeah.
if if you do some
Yeah.
analysis and you pick the right stocks, I mean, you could come out even better. So
But in a sense, when you sell the call, a covered call, like no matter
mhm.
what happens, you win, right? Like
I
from this
you
calculation.
uh well, it
On the
wouldn't have
profit, on the
expired.
total profit side. Like
Well,
like
no, that's how you take you back to the Afria example where the I bought it for 6, I sold the call at 8, and the stock kept going to the sky. I missed out on a whole bunch of upside by virtue of having sold the call. I made
yeah,
two
but as
bucks.
you said, like the cash flow was still positive $2,200,
That's right.
right? So
That's
by selling
exactly right.
calls, it's like doesn't matter what happens, you win.
Yeah, this cash flow is the $2 per share between the 6 and
Yeah,
the 8,
yeah,
right? Um, Here was the premium that I got. So I got 340 bucks premium, but I
yeah.
paid $70. So 340 minus 70 is the 270 that you see here. So yeah, I came out ahead. I could have come out a big winner if I hadn't sold the call though,
Yeah,
right? So
we can't. Yeah, that's a different game. That's a different game.
yeah, it depends how you look at it. So, but
Yeah.
to be fair, I mean, I'm still ahead. It's not something to retire on, but it is definitely a nice little add-on. And unless you're doing this professionally, uh, this counts as capital gains. It doesn't count as salary. So I looked that up. As long as you have a different occupation, then this gets taxed as capital gains. So yeah, other than the one hiccup there, everything is okay. And so right now I have one that is expiring tomorrow. I collected 184 for it. It's a call because I had gotten this one previous. I think it's called the wheel strategy, where you sell a put. If you happen to get it, then immediately you turn around and you sell a call. If you lose it, rinse and repeat. If you like Monday, I'm going to sell another call because this is going to expire worthless. So I pocketed $184. Now, truth be told, I bought this one for, sorry, I bought this one at $20. Um, I think it's currently at 17 or something like that. So yeah, I made a premium. I made $184, but during that time the stock kept going down. So yeah, no danger of it of me losing the stock, but now I have a bit of a losing stock, which I lost more money on than $184. So that's kind of the risk of the covered calls, is that you have to hold on to the stock, but you don't have to. That's a bit more advanced. You can buy it back, but you can buy the option back. But so while this is going to show as a positive, I'm actually down whatever the stock lost because I kept holding on to it. I would have held on to it
So the
anyways.
spreadsheet would calculate it if you somehow,
No,
let's say, settle it. Oh, okay.
if I were to sell it, then I would probably track it in one of these columns. I would probably track it in here, and that would change this value here. Um, yeah, this was one here. Yeah, I also, if I just sold it myself, then I also tracked it in here, but only if I sold it immediately. Like if I held on to it or something like that, then it sort of doesn't count anymore, and I don't track it in here. But if I sold it myself immediately, so there was actually one. I can't find it now. There was one where I got I got the stock and I didn't want it. Yeah, this one. So that was a put. I got the stock for $7,500 and I didn't want it. And the next day I sold it, and it had gone up. So I actually made money on that as well because I got it for 7,500 and I sold it for 76, 73. I still paid a hefty penalty for getting the stock in the first place, but I collected $1,005 in premium and I came out ahead with 1,058.
Yeah,
Um,
I think you have to look into those penalties. I don't think that's normal.
yeah, this is Q trade. So whenever you're assigned the stock, whether you get it through a put or you lose it through a call, they charge minimum $45, and then it's some sort of a multiplication of the number of shares. I got the formula somewhere, but the minimum is $45 whenever you actually get the option executed on you.
Yeah, I think it's way too much. It just eats into all your
Yeah,
profits.
I looked
Especially
at some of the
when you
others.
run it up to like 1,000 trades, that's gonna be like 10 grand gone.
Well,
'Cause,
yeah,
no, I
I
mean like
mean,
even right now, if you run up the fees, that's like more than $1,000. That's like 10% of your winnings, and it doesn't make sense just to lose it because the brokerages I use, they don't charge that.
okay. I looked
Yeah.
at Quest Trade, and I think they were pretty much in the same boat, though.
Okay.
Like
I'll double
they
check
were
my interactive brokers. I don't think they
okay.
charge anything.
Yeah, maybe Interactive Brokers is different. I've I've looked at all the different brokerages. They always there's always something missing in them, and I don't like I don't want to change. So
Yeah,
for
yeah, that's
just for
fine.
that. Um, so yeah. So I mean, I had 63 transactions in 9 months, so I'm not a high volume trader. But so I've always only sold, and I never even bought one of them back. So and I've never bought an option. So anyways, so that's my spreadsheet. I sort of built it up over time. Reason I have it is if this isn't being profitable, then I need to change something or stop doing it. So this is just to tell me that okay, you're not making money, so you should change your approach. So anyways, so yeah, that's kind of my fairly simplistic method. I'm just doing it for additional income, and I've got cash available in a line of credit that if I do get the money, sorry, if I do get the stock with a put, then I'm able to buy it. The other thing is, maybe we didn't mention that earlier, is that this is always done in a margin account where you're able to borrow against other assets that you already have in that account. Because with a put, if I sell a put and I'm on the hook possibly for $6,000, I don't want to be transferring that money in order for it to be available. I want to have a margin account where if that put doesn't get exercised and I never get the stock, I never had to transfer any money in. So this is always going to be done through a margin account. I don't think you can, but you certainly wouldn't want to do it in a regular trading account because you'd have to be transferring money in, and then it would be sitting in the brokerage with no interest being paid on it. So that would not be great. Well, thank you everybody for joining us. Hopefully you found this podcast useful and entertaining. So thank you, Rob from the Mindfull Investor, for joining us. This has been Alesh Eisner from the Canadian Money Talk. Thank you very much.
Thank you.